negative zone. Long put position holder is in positive zone. Short put position holder is in negative zone. Now you come to second situation. When the market price is 17,050, he is paying how much price to buy that asset? 17,450. So how much price, more price is paying here?
400.
So is it a loss for him or not?
Loss.
It's a loss. So simply logic is that short position holder payoff is just a mirror image of long position holder payoff. If he is into profit zone, he is into loss zone. It is gross payoff. And what will be the net payoff? What is the net payoff? He has received premium or he paid premium?
Premium is 150, so net will be 300.
Received premium.
He received 150. So what is the net amount? Net loss minus 300. In second case, minus 250. As such, we need to understand. So let us try to see now what is the next level? Minus 300 minus 250. So if I try to take these values like this, minus 150 minus 100 minus 50, I'm simply taking just it is mirror image of the first party. So 0, 0, 0. Now you tell me, instead of writing such a big table, I want to convert it into a small equation as I have done for the long position holder. What is the equation for the long position? Maximum of K minus ST are 0. It is, it is for long put. So I want to frame the equation for short put now. What can I do? Is it just minus of this? Is it just minus of the above one or not?
Yes, ma'am.
Minus of maximum of K minus ST comma 0. Instead of writing
Or
minus
minimum.
maximum, instead of writing minus maximum, can I write minimum of ST minus K comma
ST
0?
minus K.
Am I able
Right.
to then minimum of ST minus K comma 0? Is it okay if I put it this way?
Yes, ma'am.
Then what is the gross payoff for short put position? Minimum of
ST minus K, comma 0.
0. So I'm just putting in the form of equation so that we are less prone to doing mistakes. So finally net payoff is gross. Since I received premium, it is plus 150. Now you look at the mirror image of this. Say payoff diagram. How does payoff diagram look like? You carefully understand and interpret this. Whenever market is in downtrend, are we into losses or profits? When the market is in downtrend, are we into profits or losses?
Losses.
Losses. When the market profit. But is that profit great or is it just limited to premium amount?
Limited to premium.
Even if the
amount.
market goes up significantly, are we able to enjoy significant increase in the profit?
No, it is limited to premium
Yeah.
received.
So as a result, what we can say, viewpoint is moderately bullish. Viewpoint is what? Moderately bullish. And maximum gain is how much? It is limited to premium received. What is maximum loss? Unlimited. So break-even point, we will check the break-even point also. What is the break-even point even for him? It is 0 at what level? Same level, 17,300. So break-even point is strike price minus premium paid even for him. Strike price minus premium paid. Gross payoff is how much? The gross payoff minimum of ST minus K comma 0. That is gross payoff. So if we put it in the form of diagram, how does it look like? It is for long put position. If you have to show for short put position, how does payoff diagram look like? It looks like
The mirror image.
here. Whenever market is in downtrend, it will be below x-axis and downward sloping line. And when the market is in uptrend, it will be above x-axis and it is a straight line. So short put position, if you take an x-axis, spot price and maturity, and on y-axis, if you take net payoff, this is how it looks like. Is it okay? It is just a mirror image of long put position. Break-even points are same for both the parties. So is it okay up to this extent about short put position or any questions anywhere? If it is any questions? Hello?
No, ma'am.
It's clear,
So
ma'am.
shall we summarize everything, whatever we discussed till now? We will put it in this form of a small table so that it will be like a ready reference for us. Long call, long, short call, long put, short put. We have learned these 4 strategies as of now. These are basic option strategies. These are basic option strategies. Long call, long put, short call, short put. First, let us start with what is the role of the long call position? Right to buy underlying asset. Am I correct? He has the right to buy underlying asset. What is the role of short call position? Is it right or obligation? Is it right or obligation?
Obligation.
Short call
Obligation to sell.
obligation to
Sell.
sell underlying asset. Since he has acquired right, does that right come free of cost or does he need to pay some amount?
Premium.
He has to pay premium. So, but this party receives premium because he has an obligation. Now, when it comes to option, I'll write it little later, underlying asset. Next, what is the payoff? Gross payoff for long call is what? Maximum of ST minus K, comma 0. For short call position,
Minimum of A minus S.
minimum of K minus ST are 0. Next, what is maximum gain? What is maximum gain?
Unlimited.
Unlimited for long call and short
Limited
call
to premium.
limited to premium. But maximum gain, sorry, maximum loss for long call
Premium.
limited to
Premium.
premium. Short call unlimited loss. Break-even point is, what is the break-even point here?
Strike price plus premium.
Strike price plus premium for both the parties. Only the thing is that one party gets into profit zone from loss zone and vice versa. Otherwise, it is same for both the parties. So main important thing, what is the viewpoint? When do you go for long call position?
Police.
Significant bullish trend is expected. When do you go for short call position? Moderately bearish trend is expected. These are long call and short call. This is about call option. Now let us think about put option. In case of put option, what is our role? Right to selling
Sell.
of what? Selling of option or
Underlying
underlying?
Option.
Right to selling of what? Long put means his role in option is buyer. Buying the put option. For what purpose? To sell
Sell the underlying.
underlying asset.
Sell the underlying asset.
Sell the underlying asset. Short put position role is
Obligation to buy the underlying asset.
obligation to buy underlying asset. So here, does he pay the premium or does he receive the premium in long put?
Pays the premium.
In short put,
Receives.
this is the, now we will understand it. When it comes to option, long call position holder role is what? Does he buy the option, sell the option? Simple logic. Long call, it means option buyer. Short call means option seller. When it comes to underlying asset, what is his role? By looking at the second point itself, you can say his role in case of underlying asset is buyer. In case of short call, underlying asset role is seller. Now you come to put option, long put. In case of long put, what is his role?
Seller. ma'am.
Seller.
of the under-
Option. When it comes to option, is he buying the option or is he selling the option?
Selling option.
He is buying the option, whereas he is
Buying
selling underlying
buying
asset.
option. But when it comes to underlying asset, what is his role?
Right.
Seller. Seller.
Seller. Because most of the time there will be a confusion even in this case. That is why I have purposefully added these two lines. Now, when it comes to put option, short position, is he buying the put option or selling the put option? Option. Option may his role is his option
Seller.
seller. But when it comes to
Buyer.
underlying asset, his role is buyer. His role is buyer, that is obligation. I hope it is clear.
Regarding long put and short put regarding options and underlying asset again.
You want me to repeat, sir?
Right.
Yes, sir. See, when it comes to option, long put indicates what? Buying put option. Long put indicates buying put option. When you buy the put option, what right are you acquiring here? You are acquiring right to sell underlying asset. Are you clear? You are acquiring right to sell underlying asset. So since you are acquiring right to sell underlying asset, you are dealing with two different financial instruments here. One is option, the second one is underlying. So in case of options, what is your role here? Did you buy the put option or did you sell the put option? In case of option, did you buy put option or sell the put option? Long put. Long put means
Long means to buy.
buy. So when it comes to option, you played the role of buyer. But when you buy the put option, your role in underlying asset is what?
Okay.
Here I have written right to sell underlying asset. So when it comes to underlying asset, seller. So when it comes to option, you are playing the role of buyer. When it comes to underlying asset, you are playing this role of seller. Now short put. In case of short put, in case of option, are you playing the role of buyer or seller? Short
Seller.
put, seller.
Sorry.
But when it comes to underlying asset, are you playing the role of buyer or seller? Obligation to buy, on the top itself I have written obligation to buy underlying. So you are playing the role of
Buyer.
buyer. Okay, basically confusion. But when we shift to put option, people will have confusion. So that is why I have purposefully added these two lines also. Now gross payoff. Gross payoff, long put position, gross payoff. How do you want K minus ST comma 0, minimum of ST minus K comma 0. It is simply reverse and minimum. Now you tell me long position gain, is it limited or unlimited? Unlimited. But short position limited to premium. And maximum loss, long put position limited to premium, short put unlimited. Break even point for put option is strike price minus premium in both the cases. Now you tell me what is the viewpoint? What is the viewpoint in first case? Payoff diagram, if you recollect, you can easily say. Long put viewpoint is what? This is long put position. Is it bearish or bullish? When are you into profit zone? Acha, again I have to resume this. Now you see what is the payoff? Are you into profit zone or loss zone? When the market is in bearish, you are into profit zone. When the market is in bullish, you are into loss zone. So long put position viewpoint is what? Long put position viewpoint is
Bearish,
viewpoint.
bearish, bearish.
Long put viewpoint is bearish viewpoint. 1 second. Okay, bearish viewpoint, significant bearish. So short put is moderate bullish. So I'm just giving all these things we have kept at the same place, so we can easily relook into once to get more clarity here. Easy way to remember payoffs is buyer of the option has only right. Seller of the option has obligation. Seller of the option, I'm talking about option. Seller of the option means he has lost his right. He has given up his right to someone else. In return, he received premium. So wherever he received premium, it indicates that he has lost right because he sold his option. As a result, his payoff will be always minimum. Easy way to remember. Payoff for short call as well as short put is always minimum. Payoff for long positions, long call is also maximum, and long payoff for long call is maximum. Payoff for long put is also maximum because they both have right. Wherever right is there, payoff is maximum. When payoff is maximum, unlimited gains and limited losses. When payoff is minimum, limited gains and unlimited losses. If you understand this basic concept, it is more than sufficient. I'm repeating. Whenever you have taken long position in options, long position in option, either long call or long put, you have paid premium. It means you have acquired right, you bought right. When you bought right, you have maximum payoff. That is unlimited gains and limited losses. When you have taken short position in option, it means to say you have sold your right for premium. When you sold your right, what does it mean? It means to say you have minimum payoff. When we have minimum payoff, our gains are limited, losses are unlimited. That is first point we need to understand. If you look at the payoff carefully, long call maximum of ST minus K. So finally, for the last short put also minimum of ST minus K comma 0. But your viewpoints, if you see, long call viewpoint and short put viewpoint more or less same. In case of long call, significant bullish. In case of short put, moderate bullish. But payoffs viewpoints are almost same. When it comes to payoff, for long put, maximum of K minus ST. For short call, minimum of K minus ST. Here also viewpoints are significant bearish and moderate bearish. So we can see similarity. It is easy way to understand the logic behind the strategy. Is it okay, sir? Is it okay, sir and ma'am, up to this extent, all the participants?
Yes,
or any questions anywhere? So shall we proceed with the next level? We can do up to 3 o'clock. I have time. We can do one strategy now. Say, for example, when you have bullish viewpoint, you go for long position in call option. When you have significant bearish viewpoint, you will go for long position in put option. That is what we understood till now. But now I'm going to face some macroeconomic event shortly. Some macroeconomic event is going to take place. Let us say, for example, say budget announcements. Generally, these days, that news of budget is getting incorporated very fast. That is not showing any significant movements in the market prices. But generally, we take these and any major macroeconomic events, or even sometimes political events like election result being out. When this type of news happen, there can be significant movement in market prices. It means to say market can be highly volatile. When the market is highly volatile, what happens is it may fall down significantly or it may go up significantly because it depends on market conditions. If the news is favorable, it may go up significantly. If news is unfavorable, it may go down significantly. Both the possibilities are there. So let us assume there are 50-50 chances that the market goes up and goes down. Equal chances are there. Under such cases, what strategy do I need to look at? Should I buy call option or should I buy, what should I do? Because if a market goes up, I go for call option buying. Market goes down, I go for put option buying. But I don't know which side it moves. Then what should I do? What strategy should I adopt if there is any major event that takes place as a result? Huge volatility is expected. So what I'm writing here is, this situation is like that. Here, huge volatility is expected. Market may go up significantly or go down significantly. What should I do? Can you give me some idea? Which strategy should I look at? Should I look at call option? We have 4 strategies: long call, long put, short call, short put. Which strategy do I look at? Which strategy can I look at out of these 4? Or can I combine one or more strategies? It is not necessary that I should look at only single strategy. I can combine even long call, long put, or short call, short put, or long put, long call, something like that I can do.
Combination of options will take place.
Madam, can you please repeat?
Combination of
Can be
the
done.
2
So
alternatives
what
can
combination
take
shall I
place.
select now?
Long call and long put.
One for buying and one.
First point, long call,
And long put.
long call and long put. Good. So if I go for long call, what condition it satisfies?
Bullish.
Bullish. If I go for
Significant. Very bearish.
bearish, because I don't know what will happen. Either of these two will happen. So as a result, huge volatility is expected. Market may go up significantly or go down significantly. It means to say, I'm sure about one thing, it may move any direction, but I don't know which direction it is. No clarity about the direction. Then I'll go for long call and long put. So generally what we do is, in the market, we have different strike prices. I'm just, can you see my screen? NSE
Yes, ma'am.
website?
Yes, ma'am. Yes, ma'am.
Now we see at the current, close to current market price, we have seen 17,450. Okay, let us take from the current level of 17,450, market may go down significantly if there is any negative news, and market may go up significantly if there is any positive news. But anything may happen, but I'm not sure about which side it is. So what I decided is, I will buy one call option at 17,450, one put option at 17,050 strike price. So what is the price of call option? Approximately at 17,450, around 160 rupees. Put option price is around 150 rupees. So what I'm doing, I'm combining these two. When I'm combining these two, I'm writing here, you just look at it. Here, long, what is the strike price I have selected? I have selected 17,450. Long call price, how much I have selected? Long call price is 160. So I mean to say call premium 60. Put premium is how much?
150.
Put premium is
150.
150. So both together, what is the total cost of my strategy?
310.
10 rupees I'm spending for buying this. But in reality, please understand that there is a lot size of 50 for Nifty 50. Lot size of 50 means to buy one contract of Nifty 50, how much money we need to spend? 310 into 50. Okay, that is what we do. So combination of long call and long put together, we call it as long straddle strategy. What is long straddle strategy? Long call plus long put. In what ratio did you buy call option and put option? 1:1 ratio. So in 1:1 ratio, is strike price same? Are you taking different strike prices for call and put? At the same strike price, did we change the maturity or are we taking same maturity?
Same maturity.
For the same maturity, when we do this, we say that we have taken long straddle position. We have taken long call straddle position. Now I'm showing this in the form of diagram. Long call and long put. Spot price and maturity. Spot price and maturity. Say spot price and maturity is 17,000. Say I'm taking somewhere like 200, maybe 17,000, 17,050 as such I'm taking. So if you take that way, now long call payoff is what? Gross payoff? Maximum of ST minus K comma 0. Long put payoff is maximum of K minus ST comma 0. So maximum of ST, K is how much?
17,450.
450 or 0. Out of these two, maximum value. Put option, maximum of 17,450 minus spot price. What is how much total gross payoff is? Both call and put together. 0 plus 450. How much is it?
450.
450. So that way we can do. What is net payoff here? 450 minus how much did you spend? 310. So net payoff is 140. Now we will try to interpret this first of all. Can you please interpret this payoff? What is your interpretation? When the market is in downtrend, are you into profit zone or loss zone? If the market is going down, let's further, we can put it as 16,950 also. If we are further going down, are you into profit zone or loss zone?
Profit.
Are you get profit zone? When the market is going up, then also we are into
Profit.
profit zone. So are we able to derive profits when there is significant downtrend and significant uptrend in the market?
Yes.
So first thing is that. Second thing is that, where is your maximum loss? This is your maximum loss. This is the point where you are incurring maximum loss. Am I correct? Do we have any other maximum loss? No. This maximum loss is equivalent to how much? Carefully look at.
Premium. Cost of straddle.
Cost of strategy, the premium that you paid. Okay. And maximum gain is how much? How much is the maximum gain? It can be any direction. Any direction it can be unlimited. Why unlimited? In both call and put we have taken maximum gain only. So it can be unlimited. We'll try to see in the sum of a diagram now, and maybe interpretation part we will do tomorrow. This is called long straddle, spot price and maturity, and y-axis I'm taking net payoff. Basically, it is coming like this way, tick mark, but actually it comes like V because downtrend I have taken less prices. So this interpretation we will do in tomorrow's class. But if you want, you can experiment it with the same prices today. And tomorrow, if any of you are able to present it so that the class will become more interactive and more interesting. So by tomorrow, what we do is we will do the interpretation of this strategy and we'll proceed with the next strategy. Okay. Thank you all of you. Thank you so much because now we will discuss.
Thank you.
Yeah, madam, thank you. I think we have tomorrow also, I think we have your sessions.
That's it. Tomorrow
Yeah.
I will continue with the same strategy.
Okay.
Okay, so then I'm just leaving the meet, sir.
Okay. If there is any workout to be given to the candidate participants, I will send it if you have anything.
Okay,
Otherwise,
sir.
that's
Okay, sir. Fine, sir. Fine. Thank you, sir.
so. Thank you, madam. Madam has a class at 3:50, so she has to take a break between. So, madam is leaving now at 3:30. We have especially this will be useful for beginners. We have a session by Vinayak Gunda. Okay, Vinayak Gunda is from NSC. He is from NSC. He'll be joining our session by 3:30. So we can take a break. Yeah, hello. Yeah, so Vinayak will be joining by 3:30. So I like earlier, I think you can need not log out of the meeting. You can be here. I'll just pause the video. By 3:30, we'll be back. Anybody has any other discussion or anything that you want to ask me regarding whatever has been discussed? Even I can spend this break here if anybody wanted to discuss something.
So just don't miss recording these sessions because the madam's initial sessions part was not.
Okay, I'm sorry because now what is happening is I'm not having the lab attendant here who is with COVID, so I'm just managing it myself. So maybe in between, probably recording has stopped. I in fact put the recording in it. No, sure, I'll do that. I'll do one thing. I'll also send you the backup recording. Our recording of the previous FDPs I have with us. Okay, so madam, this session was the same content that was taken in the previous FTP because it is a beginning level. So that video also I can share with you so that if at all you have missed out something, you can cover it.
Please share the link.
Yeah, I'll do that.
Thank you so much.
Yeah. Okay, so I will meet at 3:30. Madam,
You can take to the live market.
you wanted to see the live market.
Market and familiarize how it is.
Oh, we can have it. Now it is not possible because the market is closed. It is 3:30 p.m. No, it is 3 p.m. only. Okay.
3 p.m.
Okay, I can do that.
No, if you don't mind, just how it gets.
Yeah, no issue. So I take NSC number. Okay, my screen is not shared now. There, screen is shared for you.
Yeah, now yes.
Yeah, yeah. So, see, when you talk about market, different people will have different ideas. Some who is trading in commodities, they would require to go to basically popular commodities exchange or multi commodities exchange of India. You have NCDX. So these commodities markets are basically open from 11 o'clock to I think evening 11 or 9 p.m. Otherwise, our regular markets, including cash segment and derivative segment, is open from 9:15 p.m. to 3:30 p.m. So, and from Monday to Saturday, you know that. So, when you go to market, basically these are the segment that you have. You have the equity market segment and you have the derivative market segment. So, in equity market segment, you would all know that it is where you have the shares being traded. NSE is not where we can trade. NSE is the platform which organizes the trading. We have to log into our broker's website. For example, GOG or Apollo Singuri, or like I showed you earlier, ICICI Direct, and we had to log in through the broker, and it is through the broker alone we can give the order specification to the exchange. So, be it now, if you look at the derivatives market, if I take any options, let me take.
Can I ask one question before you go to the options?
What is it, madam?
If it is ICICI Direct, what is that? You have the facility for cloud orders also, isn't it?
Your voice is breaking, madam.
If it is your broker is ICICI Direct also, then you have something called a cloud order, placing the order on cloud or something. How does it work?
Cloud order, but I'm not sure. I'm not used it.
I'm not sure.
I think I'll just clarify and let you know. Cloud order means, if I'm correct, I think your order trade book will be stored in a separate. I think it operates like a drive concept. I have to check it. If somebody else knows that, they can explain. In ICICI Direct also there is order placed through cloud. So it is of a reason this thing, but it's not. I think it's a. Just check it. There is no other. Another site will not work because now I'm in the university. Trading sites will not work. I'll just check it and tell you what is cloud. Cloud is not anything pertaining to the body of knowledge of derivatives. That is a technique. I mean, IT domain. I'll let you know. In which context you are storing your orders.
How does it work? And when you place an order, if it is on cloud, then how is it?
I'll check it and tell you. Cloud order. I'll check it. I not use it.
Now I suppose we can.
Yeah, thanks for pointing it out. I have also not uploaded. I'll check it and tell you. Yeah. So coming back to this thing, so in this segment, you can use say just to take you through. Let me take. See, you can take. First of all, you have to choose as to what segment you want to go in. You can go for stock futures or stock options, or you can go for index futures or index options. Okay. So what is an index option? Like a stock is underlying. Sometimes an index can be an underlying. The Nifty is an underlying asset. Nifty has futures. Bankex futures are there. Financial institution futures are there. Financial institution options are there. So these are nothing but different types of underlying. You want to go for a stock or you want to go for an index. Just if I take futures, this is what is the what is it? Let's go with State Bank of India.
Okay.
State Bank of India. So what is it? I'll just tell you with NCA that it's easy for you to relate. Yes. Data. Take gold, let us take gold commodities. So now, see, the recording on. The recording on. The
Yes, sir. Yes, sir. It is on.
Yeah,
It
yeah,
is
it
on.
is on. It's on. Okay, so see, this is again another exchange like NSE. This is a multi-commodities exchange where usually you have commodities that are available for trading. You have from different metals to agriculture commodities. You have even currencies to precious metals. All these things are which are available in MCs. So now what is this? This is October 5. So this is gold. This is the underlying asset. You can choose futures or you can choose options. So commodities also options and futures are available. So now just to tell you, this is the October gold futures. Now what rate is October gold futures trading for? Is trading for? My Excel is also visible to you?
Yeah.
Yeah. Now what rate is October futures trading for?
7,134.
It is trading at 47,134. Is it? Now, what is the lot size? Lot size is
10 grams.
what is per gram? So, so let us say quantity is 10 gram. Okay. And now, what is the current market price? Anybody know what is the spot price? The spot price should be available somewhere here. Spot market price. Okay, let us look at the spot price of gold. Spot price of gold is how much?
47,170.
7,170. So this is October futures, and this is current spot price. Somebody was asking earlier in also like does futures affect cash price or does cash price affect futures? An empirical relationship, if you want me to tell you, it would be something like this. We convert this into commas so that I can. Yeah. So there is a difference. What is the difference? What is the difference? The difference is spot is trading higher now.
Yeah.
Spot is trading higher than the futures. Now, so we discussed, what should be the futures price? Actually, the cost of carry model or the true theoretical futures price should be what? This should be
Great.
spot price plus
Plus
cost of carry. What is cost of carry? Cost of carry is this
Europe.
divided by, let's say, okay, let's say R is, let's say R is 10% or 7%. Okay, R is 7%. So what is it? Cost of carry should be this plus this
0.1 by
divided by 1 plus R is 2.
0.07 by 2.
Not this. I think this should be 0.07. It is 7%. Should be 0.07. Okay, and what should be N? N should be how much? How many days are there? It is October 5th now. So today is September. Today is what? 14, no? 15. 15, 9, 2021. 2021. And this is moving on 05, 10, 2021. 15, 9, 22. Let me see if I can get the difference here. Now, how many days are there? Is it possible to get the difference? This minus this. I don't remember the formula. Yeah, we can get the days. So time is 20 days. Okay. So the actual futures price would be raised to how much? 20 by 3. Now So this should be the actual futures price. Is it not? Is that correct? Are you getting what I was doing? So this is the spot price. Is it not? So in the NCS exchange, you found that what is it? The spot price we found out. We also no, this is the futures price. Now probably the price is slightly changed because the market is on. So however, at the time we were looking at, the price was 134. Now what is the price? It's 145. It has increased by 10 rupees. So let us go by this. The futures price is 134, but theoretically the price should be 47,173. So we will say that futures are underpriced. So what can you do now? What can you do? Suppose you have some gold at home. Let us say you have 10 grams of gold at home. So you seeing this, what you will do is you will go out to the Broadway market and sell your, my screen is visible, I believe, as worksheet. You will sell your 10-gram gold if you have the gold with you. So when you sell 10-gram gold, how much money do you get? You get the spot price. This is not, this is the spot price that is applicable. Huh? So this money, when you sell your 10-gram gold, you get 47,171. Now what can you do? This is step 1. So what is step 2? Step 2, you can deposit this money. You can deposit what is it? 47,171 at the rate of what is R? What is R? R is 10%. Okay, so
7.
Yeah, so you are depositing it. So third, what happens? Third, on October 5th, what will happen? This will mature for how much?
170.
Huh? This will mature for the future price, is it not? This is nothing but this plus cost of carry, is it not? This will mature for this amount exactly. Is that correct? 47,171 plus you are deposited at the rate of R for these many days. So for these many days, the interest will be, or if you want to calculate, you can calculate it here. Huh? This is equal to this plus this divided by how much is R? R is 7%. Okay, R is 7%, and R raised to how much? 20 days. Huh? Not okay. R raised to 20 by 3. What is it? What is G9? G9 plus G9 divided by D2. What is D2? Okay, D2 into G1 D. Something somewhere I missed.
D9 into D9 into
What is it? G? D9 plus
D9 into D.
D9, madam?
D9 into D by, isn't it? You're calculating the interest.
Yeah. G9 plus.
D9 into D, isn't it?
Oh, somewhere I missed out. What did I write here? The C7 plus correctly. So once again, this divided by so this plus this is the less amount divided by R is what? R is 1%. By 365 days. Gone wrong. Where I missed it out. G9, G9. Thank you. Bracket is the bracket and now let's get it. I think the bracket, I put the bracket. Okay, now. So what did you do? You found that the purchase price was underpriced. So what is your course of action? Suppose you have some gold at home. What you can do is you can sell this gold. So when you sell this gold, you can get the what is it, cash price, spot price, which is 47,171. Now you can invest this money into your bank at the rate of R. That will automatically mature your deposit by 5th of October at the rate of 47,173. I think this is acceptable. Till here, is it clear? How do you get 47,173? Is that clear for all of you? So no, Ramana madam. Hello.
Yes, yes, yes. We are adding the cost or the opportunity cost. Isn't it?
Yes, madam.
We are adding the cost element there, isn't it?
Yeah. Not cost element. You are adding
Interest.
the amount that you realize. So
Yeah.
you put it in the bank. You are adding the interest element with that, so that
Yeah.
you get the
It's your
maturity.
opportunity cost.
Okay. So now what you do is you can have one more this thing. Let us say you're selling 10-gram gold and you are buying the October gold FUT. So now what will be the consequence? So step one is you're selling the gold and getting 47,171 rupees, and also at the same time you are buying the gold futures. Okay, then you go to step two. You are depositing the money at R for till 20th of October. So sorry, 5th of October. So on 5th of October, you are getting 47,173 rupees as your maturity amount. Now, on 5th of October, what right do you have in your hand? Remember, you have already bought one gold futures. This gives you the right. This gives you the right to buy gold at the rate of how much? What is the gold futures trading for? 47,134. So now, this gives you the right to buy the gold at the rate of 47,134. So on October 5th, what will happen? You will be left with how much rupees? How much rupees will you have in your hand? On October 5th, your maturity amount is 47,173. You have to spend 47,143 for buying the gold. So therefore, you will have this minus as your take home, 39 rupees. This is possible. This is called the arbitrage process. Now, this is possible. So no. Hello. Is this possible? So what happens is, when the futures price tend to be above or below the theoretical price, any one of us can intervene into the market and take this free lunch. This is called the arbitrage process.
Yeah,
So when you take
possible.
this free lunch, the course of action is you are actually selling the gold and you're buying the futures. So when you sell the gold and buy the futures, selling pressure will bring down the spot price of the gold. Buying of the futures will lift the futures price of the gold. And finally, the price will actually settle at the theoretical level. This is what happens in a real market when the prices are trading away from the theoretical level. Is this clear? Yeah.
Okay.
If you want me to have one more round of explanation, I can give it to you in the next class. Maybe because you're having another one session. Since somebody was asking, they wanted to just check what happens in the real market. These are the things usually that you can find happening in the real market. Otherwise, what is it? What else you want to know, madam, about the market? You wanted to know something about the real market.
Just
So, what was it? Anything else
to
you
have
wanted?
a feel of, especially now you talked about futures.
Ah.
No, this is about futures. Okay,
Yeah.
so how do we choose between options and futures? Okay, I think we will be getting into the next section. For my
You mean
question.
any such mechanisms in options? Options also, there are some arbitrage possibilities, like there is something called parity possibilities are there. There is something called lower boundaries and upper boundaries of option. So when options actually violate these properties, we have some risk-free profit-making opportunities, which is scheduled for your fourth week. So I'll be discussing that on the fourth week.
Okay.
Option property.
Okay, we'll wait for that, sir, because we are almost in time for the next section. No?
Yeah. Anyway, I'll just keep in mind that you wanted to have some more discussion on live market. I'll manage that. Okay, madam. So let me just check if Vinayak is ready. Able to understand what has been discussed?
Yes, sir.
Yes, sir, completely.
Okay. And what about advanced learners or intermediary learners? You are also getting marginal understanding. Incremental understanding.
Yes, sir, it's quite incremental because see, I'm a theoretical guy, so practical aspects of options market, like what you showed on screen, was very valuable for me.
Yeah. So definitely, when you get back to your institutes, you should take that effort to, also, motivate the students to actually put their mind and understand, rather than usually derivatives and risk management papers, students take it as they do not put their mind. They completely, to an extent, by heart and go. When they come out to different industries as investment advisors and other people, they find difficult to, deal with such kind of scenarios. So we should definitely motivate the students, and it's a highly paid segment if you go in the management, treasury, and derivatives. Definitely, we should be motivating our students. I think Vinayak will also be touching upon the importance of NISMs, etc. Because that is mandatory for somebody to work in this segment. Motivate the students for taking NISM exams, etc. NSE is also now coming with a lot of professional programs in securities market. Vinayak, are you there? Vinayak, could you join? Rija, madam, how are you? I think this is the third program or the second program that you are joining us. You, yeah, madam is there.
Okay, sir.
How are you, madam?
I'm fine.
Fine.
We have to do the promotion, no? We have to do FDP courses for that.
Career advancement.
Yeah.
Okay.
So,
yeah, madam, as per the latest UGC, there is order in the UGC website. in lieu of refresher or orientation, you can have two 5-day programs that will be considered equivalent to
Yeah. Yeah, that's why. But the earlier one that I did, I think it was not recognized. First
No, madam,
one-
no. University programs will be recognized.
Okay, okay.
Did you find any issue with that?
No, I haven't given that.
No, madam, even it need not be university, any UGC or ACT recognized institutions conducting an FDP program, that is enough.
Okay, okay.
Definitely, last program was conducted by the department in the university. Definitely, that's right.
Oh,
But when you
sir.
have an ATAL, hello.
okay.
Yes, sir.
Yeah,
Vinayak here.
Good afternoon, sir.
Good afternoon, sir.
Shall we start?
Yeah, yes, we can.
Yeah. So, dear participants, we have a very young person, Vinayak Gunda. He's been associating with us for the last 2 or 3 FDPs in derivative segment. He is a manager in National Stock Exchange. He was introduced to me from one of my good friends, Gokul. Gokul was earlier with SEBI. Now Gokul is also with NSE. So Gokul also used to associate with this program, but this time Vinayak is here. Vinayak's sessions are very very much appreciated in the previous series. He used to give a very convincing view of microstructure of the market. Some of you were asking yesterday how clearing and settlement, what is CDSL, NSDL, etc. So he is the right person to speak on that. His narration is also very good. So both even for advanced learners and also for early learners, all those microstructure of the markets, practices, two things otherwise we used to ignore. Probably you can put it up here. Vinayak will be elaborating on that. Sir, welcome to you to this ATAL FDP on behalf of the School of Management Studies. I'm handing over the session to you. You can take it.
Thank you, sir. Thank you for your warm words. Please allow me to share my screen. Sir, is my screen visible? Okay, fine. Once again, good afternoon, everybody. My name is Vinayak and I am from NSE, National Stock Exchange. I am from Hyderabad office. I work in the Hyderabad office. Like Hyderabad, we take care of AP and Telangana. So basically from Hyderabad office, we look after the members registered from these two states, and also we have investor services cell. And apart from that, we have many educational programs being offered from NSE by me. For all our educational activities, we have a separate entity called NS Academy Limited. So I believe most of you might have already heard about NCFM certifications and other certifications. So all these certifications have been are being offered under this entity called NS Academy Limited. NS Academy is basically a 100% subsidiary of NSE. Okay, going back to our topic, I have been given this topic, derivatives. I believe since most of you, I mean, in fact, all of you are trainers, faculty members, respective faculty members. So you definitely have an idea of derivatives. But again, for the larger interest of the participants, we'll just start with some basics. So basically, derivative is a contract between two parties, and the value of the contract is derived from the value of the underlying asset. So basically, two parties enter into a contract based on some kind of asset. So they try to exchange some kind of asset, and based on that value of the asset, the contract value is derived. So the underlying asset, it can be bullion, that is your gold, silver. Then it can be an index, it can be a stock, it can be bonds, metals, agri-commodity, energy, and currency. So presently, these are the underlying assets available in the market on which we have derivative contracts available. coming to the history and importance. So the concept of derivatives is very old. It is not something which has been designed some 2-3 decades back. It goes back to some centuries. So it can be tracked back to the Mesopotamian era, when the 6th Babylonian king allowed sale of goods and assets at a pre-agreed price delivered at a future date. So this particular transaction which has been mentioned here is nothing but a derivative contract. So the primary purpose of entering into such kind of contract, or primary purpose of these derivative instruments, is to ensure commitment towards the price for future dates, for giving protection against adverse movements in future prices, to reduce the extent of financial risk in financial markets. So basically, in simple, safeguarding each other's position, because the market is volatile, the movements, the value of the asset can go up or down. So just to safeguard that particular risk, these kind of derivative contracts are being entered into by various parties. So that is a major purpose of derivative contracts. Okay, so what are the types of derivatives available? These are the 4 types of derivatives available in the market: forwards, futures, options, and swaps. I believe you all might have heard about these types of derivatives. We'll just go into futures and forwards first. Like, we'll distinction between futures and forwards. Futures get traded on an organized exchange, that is on stock exchange. The contracts which are available are known as futures contract, and the similar contract which is available in the market, that is on the OTC, over the counter, that's called a forward contract. And again, as informed, it's a standardized contract, and with respect to forwards, it will be a customized contract. As per the requirement of the party, the contract will be designed. But whereas in futures, the contract is fixed. I mean to say, the value of the contract or the number of lots, everything is standardized in a futures contract. The liquidity will be more on futures because you have a established platform, that is stock exchange platform, and you have many parties who trade on the exchange platform, who transact on the exchange platform. So definitely you have more liquidity on the futures contracts and less liquidity on the forwards. Requires margin payments for futures, yes, because to safeguard the risk and to safeguard the system as a whole, exchange will be collecting margin from the parties. There is no margin payment from the forwards. Why? Because basically, as I told, they are standardized contracts and the parties are well known to each other, and that's why they will not be collecting any such kind of margin just because of the because they interact on a day-to-day basis, or they know each other very well. Just because of those kind of reasons, they don't collect the margin. Or say in other case, example, bank will also provide such kind of forward contracts with respect to foreign currency, USD, INR, GBP, INR type of contracts. So there, both the parties which enter into such kind of contracts are the customers of the bank. So banks, they have a well-established relationship with the customers. They have their bank accounts with them. So basically, the money is under control of the bank. So there is no reason for the bank to collect such kind of margin, because anytime when any adverse movement happens, bank will have control over the accounts of the parties. So that's why there is no such margin payment in the forwards. You have something called daily settlement. Again, to mitigate the risk, to reduce the risk, and to safeguard the system, you have something called daily settlement available in the futures. Whereas in forwards, you don't have such kind of daily settlement. It happens only once, that is at the end of the period. Lower counterparty risk, because here we have exchange. Exchange is safeguarding the market. Exchange will act as the guarantor. So there is lower counterparty risk. And whereas with respect to OTC, there is high counterparty risk. Then you have something called swaps. Swaps are nothing but private agreements between two parties to exchange cash flows in the future according to a pre-arranged formula. They can be regarded as portfolios of forward contracts. So customized or improvised version of forward contracts. And the commonly used swaps are interest rate swaps. Say, for example, one particular person has taken a home loan from a bank called A. So this person has taken a home loan from bank A at a rate of say 8%, and there is a like a fixed rate of interest, say assume. And you have another scenario wherein another person has taken loan from bank B at the rate of say 9%. Now one person has taken at 8% and another person has taken at 9%. Say the person who has taken at 8% is of the opinion that the rate of interest is going to increase more, and the person who has taken the loan at 9% is also of the same opinion. So both of them, they want to safeguard their position, so they will be exchanging their payments. So the person who is supposed to pay at 8% will buy the loan of the 9% guy, and he will be honoring those payments, and the person who has agreed for 9% will be taking the payments of the 8% guy and will be honoring those payments. So since both of them had a different view about the future, the person of the 8% guy is of the opinion that it will go to 11% or 12%, and the person had the same opinion, but he has agreed to go for this particular person's transaction. So in this way, basically the interest rate swaps happen, and they are not pretty common in India as of now. They are basically, they happen in the US markets. Okay, so that is interest rate swaps, and then we have currency swaps. Coming to the derivatives on exchanges. So in the previous slide, I have shown you 4 types of derivatives, that is futures, forwards, options, and swaps. But on the Indian exchanges, we have only 2 types of contracts available, that is futures and options only. Okay, on the exchange platform, you have only these 2 types of contracts available, futures and options. The derivative segment again is classified into 4 sub-segments on the exchange platform, that is equity derivative segment, commodity derivatives, interest rate derivatives, and the currency derivatives. Again, basically based on the underlying. So in equity derivatives, you have the stocks and indices trading. Under commodities, you have these various commodities like metals, agri, energy, bullion. And under interest rate derivatives, you have the government securities, that is GSEC and 91-day T-bills. And under currency derivatives, you have these 4 currency pairs available: USD INR, GBP INR, Euro INR, and Japanese Yen INR. So based on the underlying, the segmentation has been given like equity derivatives, commodity derivatives, interest rate derivatives, and currency derivatives. The participants in the derivatives market, obviously stock exchange, then the investors, regulatory authorities, here obviously being SEBI, and various market intermediaries like your stock brokers, depository participants, clearing banks, clearing members, all those entities. Types of investors: hedgers, speculators, arbitrageurs. Hedgers who want to hedge their position, who already have that underlying asset physically with them, and who want to safeguard their asset because of the adverse price movements. They enter into such kind of contracts to hedge their position. They are called hedgers. Speculators, they just speculate. They don't have the asset in their position, but they speculate. They just buy and sell contracts. Arbitrageurs who want to take advantage of the price difference in 2 different markets. Like if you consider derivatives, you have something called spot market and the derivative market. So if the spot price, I mean the difference between spot price and the futures price or the derivative price is more, they try to gain out of it by taking opposite positions in the each of the market. Like they might buy in spot, sell in futures, or buy in futures and sell in spot. So basically they take advantage of the huge gap in the prices in two different markets. Coming to futures and options in detail, I'm sorry. Okay, hope I'm audible now. Can anybody confirm, please?
Yes, sir.
Yeah, fine. Coming to futures and options in detail. Okay, so what exactly is a futures? It's a contract between two parties. So one party will be buying a futures contract, one party will be selling. So two parties to buy or sell an underlying asset at a certain future date for a particular price that is pre-decided on the date of the contract, and the deal is made through an organized and regulated exchange. So simple, a contract which has been executed on the exchange platform, and it's a contract between two parties to buy or sell an underlying asset at a certain future date for a particular price. It's called a futures contract. So basically in futures, as I said earlier, you have only two positions. You either buy a future or you sell a future. So in exchange parlance, it's called going long, means buying a future. Going short means selling a future. So what exactly will be the difference between buying a future and selling a future? So with respect to right of the contract is concerned, the future you have the right to sell. Margin is applicable on both the contracts. That is, buyer also will be paying margin, seller also will be paying margin. Profit unlimited, loss also unlimited. So features of a futures contract: contract between two parties executed through exchange, centralized trading platform, that is the contract will be traded only on the exchange platform but not on any other platform. Price discovery will happen because it's a free market. You have huge liquidity. Many buyers and sellers are readily available on the market at any given point of time. So demand and supply factors will play in. Margins are payable by both the parties, minimizing the default risk, and quality and quantity all decided today and in standardized terms. So quality basically will come into picture when it's a commodity. Like we have derivative contracts on paper, rubber, gold, silver, etc. So there this quality aspect will come in. A snapshot to understand the futures contract. So basically I'm sharing you a snapshot of the Nifty futures contract. So here if you see, for futures contract, this is an index futures and the underlying index being Nifty, and you have at any given point of time 3 contracts available, that is July, August, September. So once 29th July, on the date of 29th July, the October month contract will open. So if you see now you can find September, October and November month contract at any given point of time. I mean 3-month contract at any given point of time. And here you can see the price of the futures contract, that is the last traded price, how much change it has happened, percentage change, etc. All those things will be mentioned. And you might be aware that for every contract there will be something called expiry. So this 29th July, 26th August, 30th doing nothing but the expiry of the contract. That is the contract will get closed on that particular day. So this day is nothing but last Thursday of every month. So this 29th July, 26th August, 30th doing nothing but the last Thursday of every month, and that will be the expiry date of the contract. Okay. Coming to the payoffs, like what exact will happen when you buy a future, like what is the volume of profits or losses a person will get. So say suppose you bought a futures contract at a level of 6,000. So generally when we buy something and if that price increases, we'll be making money. So here, when I bought this contract at 6,000 value, and as and when the Nifty index goes up, I'll be making money. So this particular portion is my profit area. I'll be making money when the price increases, when the Nifty goes up, or when the underlying asset price increases, I'll be making money. And vice versa, if the price falls, obviously I'll be making loss. So here my scope for profit is unlimited and loss also is unlimited. So it can go either way, unlimited profit and unlimited losses. So this is the payoff for a buyer of a Nifty futures. Now let us see for a seller of a Nifty future. So obviously seller, he will be making money when the price falls. So when the price increases, he will be making money when the price falls. Okay. So when the price falls, this will be his profit. Okay. So as and when the price falls from 6,000 to and below, say 5,000, 4,000, that will be his profit. And if the price increases, this will be his loss. Again, similar to a buyer of a future, there is unlimited profit and unlimited loss. So buyer of a future will make profit when the price increases, and seller of a future will make profit when the price decreases. Okay. Hope I'm clear till now. Can I go forward?
Yes, sir.
Yeah, fine. Coming to option. So we have seen about futures. Now coming to options. Options are in general, if you observe, they are nothing but basically your insurance contracts, just like an insurance contract. In insurance contract, what happens? Say you take a two-wheeler insurance policy or a car insurance policy. You pay something called premium to the insurance company, and you are buying a right from the insurance company. What is that right? In case something happens to your car, be it theft or any damage or any other loss to your car, or say a minor accident, you will be having the right to claim such money from the insurance company. Why do you have that right? Because you are paying something called a premium. By paying this premium, you are having this particular right. So example, if something really happens to the car, say the car has been stolen, obviously after doing the proper documentation, you can execute your right. You can submit all those documents to the insurance company and you can claim damages from the insurance company. Similarly, on the exchange platform also, options contract also behave in the same way. So basically they are contract between two parties, but not an obligation to buy or sell the underlying asset on or before a stated date at a stated price. So here again, like buyer of a future, seller of a future, you also have buyer of an option, seller of an option. Buyer of an option pays the premium and buys the right. Seller of an option will receive the premium and is also called the writer of the premium. And this seller will always be under the obligation to sell or by the underlying asset. So the buyer who is paying the premium will have the right but not the obligation. The seller who will be receiving the premium will have the obligation to sell or buy. Going further, these particular options have been classified into two types: call option and put option. Okay, we'll see what are they. Coming to call option. Call option is an option which gives buyer a right to buy the underlying asset. So, say example, I am buying a HDFC Bank call option. Now, in this options contract, there is something called strike price. Unlike futures, in options you have something called strike price. It means like you are telling that on a particular date in future, you will be buying HDFC Bank shares at a price, say 1,000 rupees. Okay. So on 29th September, I will be buying 100 shares of HDFC Bank at 1,000 each. So this is the call option. Now, here what happens on 29th September, if the price of HDFC Bank goes up, say in the market on 29th September, the price of HDFC Bank has gone to 1,100 rupees. So what will happen? Since I bought this option, I am the buyer of this option, wherein I am telling I will September at 1,000 rupees each. Now on 29th September, the market price is 1,100. So since I am the buyer of the option, I have the right to buy. Okay. So I will execute this contract. The person who is on the opposite side, that is the person who sold the call option. I am the buyer of the call option. The opposite person is the seller of the call option. For him, I paid the premium. So I have the right to execute this contract, and he will be under the obligation to sell me HDFC Bank shares 100 quantity at 1,000 each. So straight away, what will I do? On 29th September, I will buy at 1,000 rupees from him 100 quantity, and immediately I will sell it off in the market for 1,100 rupees. So straight away, I'll make a profit of 100 each. 100 into 100 quantity, 10,000 rupees will be my profit. So this is an example of a call option. So in this call option, I bought a call option, so I have a right to buy. And as a buyer of a call option, I will be making money only when the price increases. The seller of a call option, he will be making loss if the price increases. Okay, this is about call option. Coming to put option. Put option gives the buyer right to sell. So here, what will happen? I will say as a buyer of a put option, I will tell I will sell 100 shares of HDFC Bank at 1,000 rupees each on 29th September. Okay, I bought a put option, and the terms of the put option are I will sell 100 shares of HDFC Bank at 1,000 each on 29th September. Now, since I am buying this right, there is opposite person who will be selling it. So the seller of a put option will receive my premium. I will be paying the premium because I am the buyer of the put option. He will be receiving the premium because he is the seller of the put option. So again, on 29th September, if the price of HDFC Bank has come down to 900 rupees in the market, if it has come down to 900 rupees in the market, so what will I do as a buyer? Since I have a right, I will execute this contract. Why will I execute? Because I will be making a profit. How? Simply because I will be buying at 900 from the market and I will be selling it to him at 1000 rupees each. Straight away, profit of 100 into 100 into quantity, 10,000 will be my profit. So in simple, call option, right to buy, put option, right to sell. That is the only difference. So buyer of an option has the right but not the obligation, as I mentioned earlier, because he's paying the premium. Seller of an option or writer of an option, he'll be under obligation to buy or sell. Okay. Again, just going further to understand it in a better way. In options, we also have something called in the money, at the money, out of the money, or nothing. In simple, it's called moneyness of option. Moneyness of option is nothing but whether the particular option on a given day is giving you positive returns or not. ITM means positive cash flow. ATM means zero cash flow. OTM, out of the money, means negative cash flow. Okay. So whether it's a call option or put option, this will be applicable to both types of options. That's ITM, whether the option is in ITM, ATM or OTM. Again, for beginners, please keep in mind that whenever you are learning about moneyness of option, or whenever you want to study the moneyness of option, always think it from the buyer perspective. Whether it's a buyer of a call option or buyer of a put option, think from the buyer perspective only. Okay. So in the money option, this option will give holder a positive cash flow if it is exercised. If it is exercised, whether it will lead to positive cash flow or not. If it is positive cash flow, it's called in the money. So call option is said to be in the money when the spot price is higher than the strike price. So in my previous example, HDFC Bank, in my example, I told strike price is 1000. Okay. Spot price on 29th September was 1100. So 1100 minus 1000. That is giving me a profit of 100. So that's a in the money. Again, similar example under put option, I told you strike price is 1000, spot price is 900. So for a put option, if spot price is lower than the strike price, that will lead to ITM. ATM, no profit, no loss. That is spot price is equal to strike price. OTM, vice versa of ITM. So for call option, if strike is higher than spot, it's OTM. And for put option, if spot is higher than strike, it is OTM. So this is too much of theory. Let us try to see with an example. Understanding moneyness with an example. So left hand side will be your call options. Right hand side will be your put options. Say example, today the spot price is 15,000. Okay. Today the spot price, the underlying asset value in the market is 15,000. And these are the various strike prices. Various strike prices. Okay. So spot price is 15,000. Say if I have taken a contract with a strike price of 14,600. So obviously on that closing date, that is today, since the value is 15,000, I will be making a profit of 400 because it's a call option. I will buy it at 14,600, sell it at 15,000. Same way, 14,700 strike. This is also strike is lower than spot. So this is ITM. So all these strike prices are lesser than the spot price. So these contracts when executed will lead to positive cash flow. I will buy at 14,800. I will sell it in the market at 15,000 because it's a call option. It has the right to buy at this particular determined price. So all strikes above the spot price will be OTM because these will generate negative returns. Obviously, I will not buy at 15,100 and I will sell it at 15,000. I will not buy at 15,200 and sell it at 15,000. Okay, so for call options, these are in the money, these are out of the money. Obviously, for put option, these strikes will be out of the money and these strikes will be in the money. Okay, hope it is clear. I'll just pause here if you have any questions, or I can go further. Can I move on?
Yes, sir. Please proceed.
Okay. So understanding options in a nutshell, long call, nothing but buying a call, short call is nothing but selling a call. So obviously who will have the right? Buyer will have the right. Obligation will be with seller. Premium he will pay, he will receive. Risk limited to the extent of premium. Risk is unlimited to the seller. Profit is unlimited. Profit here is limited. So this profit and risk part I will explain you with the help of a graph. Now coming to put option, same. Right will be with the buyer of a put option. Obligation will be with the seller. Premium same. Again, for buyer of a put option, limited risk, that is to the extent of premium, and unlimited for the seller of a put option if the prices go down. And profit limited to the seller of the put option. Now, why this profit is limited or unlimited, unlike futures contract? Okay, so generally for futures contract, we have seen that the profit is limited. I mean that the profit is unlimited and loss also is unlimited, both for buyer and seller. But if you see for an option, that is buyer of an option, and again buyer of a call option, the profit is unlimited, loss is limited. Let us understand with an example. So here, what I have taken is, I have taken a contract with a strike price of 6,000. Okay, I bought a call option with a strike price of 6,000, and for that I paid a premium called 100 rupees. Okay, so as mentioned earlier, the buyer will pay premium, seller will receive premium. So here, since I am the buyer, I am paying a premium, and this premium is 100 rupees. So again, as I told, if it's a call option, I'll be making money if the price increases. So as and when the price goes beyond 6,000, I'll be making profit. So in this particular example, my break even will be 6,100, because say it is at, since I paid already 100, if I buy it at, I mean, if the spot price, that is the market, in the market, the price is at 6,100. So though the option is in the money, here what will happen? I will buy it at 6,000, sell it at 6,100 in the market. So my profit will be 100, and the premium which I paid also is 100. So net, I'll not be getting anything. So that's why I'll be making profit only when it crosses 6,100. Hope it is clear. So here my break even will be 6,100, and any price beyond 6,100 will make me profit, will be giving me returns, positive returns, and that scope is unlimited. The price can go to 6.5, 6.6, 6.7. So there is no such limit. Until the price goes beyond 6.1, I'll be making profit. Now what happens if the price falls below 6,000? So it's a call option. I have the right to buy the asset, and I agreed to buy at 6,000. Say on the date, if the price has come to 5,800. So simple, I will not do anything. I will not execute the contract. I will just leave it to expiry. I mean, I'll just leave it like that. I'll not do anything with the contract. Why? Because since I have the right to buy, I will be forced to buy at 6,000, and I'll be selling it at 5,800, 200 rupees loss. So since I have the right, or to say I can decide whether to buy or not, I will take a call. So since this particular contract, if the price is falling to 5,800, will lead to negative cash flow, I will not execute a contract. I will simply keep quiet. What I will be losing is 100 rupees, which I paid towards premium. So that's why in buying a call option, your loss is limited to the extent of premium. Your profit is unlimited. Loss is limited, profit is unlimited. So unlike futures where the payoff is linear, that is unlimited profit, unlimited loss, in options, the payoff is not linear. Your loss is limited, profit is unlimited. So this is for the buyer of a call option. Similarly, for the seller of a call option, the person who has sold the call option, obviously for him, the option will lead to profit when the price falls. When the price falls below 6,000, that will be his profit area. And when the price goes above 6,000, it will be his loss making area. But here the catch is his profit is limited to 100 rupees. Why? Because in this case, what happens? The buyer, if the price is falling beyond 6,000, he will not execute the contract and he will simply lose 100 rupees. So that 100 rupees will be his gain. So he will be hoping the price to fall and he will be booking a fixed amount of profit. But if the price increases, again, if the price increases, it will be his profit area, and for seller, it will be his loss area. So his loss is unlimited because he doesn't have any control over the price. The price can go to any level and his loss also can go to any level. That is the buyer of a call option payoff and seller of a call option payoff. Okay. Now coming to buyer of a put option. Again, as mentioned earlier, if I buy a put option, I'll be making money if the price falls because it is a right to sell. It is a right to sell. So in cases of right to sell, I'll be making money when the price falls. So as and when the price falls beyond 5,900, I'll be making profit. And if the price increases beyond 6,000, that will be my loss again, but it's a limited to 100 rupees. That is a premium which I have paid. So 5,900 will be my break even. 6,000 is the strike price which I fixed for this contract. And this will be the break even. Any price falling below 5,900 will be my profit area. And this will be my loss area. If the price increases, it will be my loss. And again, similarly, for the seller of a put option, same. If the price falls, he'll be making losses. If the price increases, he'll be making profit. Again, profit is limited to the extent of premium. Loss is unlimited. So this is about payoffs of call options and put options. I will take a pause here. If you have any questions, please.
Sir, I have a doubt.
Yes,
Sir,
please.
so is it that the buyer of the call option, he's getting unlimited profit, right?
Correct.
So is it always advisable to buy then?
No, because, okay, I mean, you mean to say if the prices will go up, yes, you can, if you have the view that price is going to increase, then you can go for the call option, ma'am.
Fine.
Okay, going further, coming to the clearing and settlement part. So basically, clearing and settlement, what does exactly clearing and settlement mean? Clearing is nothing but identifying the obligation. Identifying the obligation. Who is the buyer? Who is the seller? Who is supposed to pay money? Who is supposed to pay shares? Who is supposed to receive money? Who is supposed to receive shares? That is the clearing part. Settlement, ensuring that the transfer happens. So we will be debiting, we'll be collecting money from the buyer, giving it to seller, or we'll be taking shares from one party and giving it to the party who is supposed to receive shares. That is the settlement. Settlement basically means nothing but the taking the funds and securities, debiting funds and securities from the concerned party and crediting it to the respective party who are supposed to receive it. So clearing and settlement. So on the exchange platform, for this is an important activity, clearing and settlement, because this defines the market. This safeguards the market, this clearing and settlement activity, and how best it is done. That will define the future and will safeguard the market and the market participants. So we have a robust clearing and settlement mechanism. I'm talking about NSE. So we have a strong clearing and settlement mechanism, and this clearing and settlement activity is done by a company called NCL, NSE Clearing Limited. So this NCL company takes care of the clearing and settlement activity for NSE. So basically all transactions, not only derivatives, be it your equity, buying shares, that equity segment, derivative segment, all segments, the clearing and settlement is done by this entity called NCL. Earlier, NCL was called as NSECL, National Securities Clearing Corporation Limited. Around 3 years back, it has been changed to NCL, NSE Clearing Limited. Okay. So settlement involves receiving or paying funds. Clearing and settlement process has been automated at all derivatives exchange. So this is completely automated because we will be having control over the bank accounts of the broker. Say example, when you buy shares, you will be transferring money to the broker. So broker will be parking that money in one account called settlement account. So as a clearing and settlement entity, NCL will have control over that particular bank account. So as soon as the money is placed in the bank account, and on every daily at a particular time, the account will be debited. So member is bound to make funds available by that time. Say example, T+2 settlement, I think you are aware. If you are trading today, if you are buying today, you will be getting shares on T+2. So exchange also will be collecting funds from the broker on T+2 morning. So by T+2 morning, the broker has to make the funds available in the bank account, in the settlement account. On T+2 morning, exchange will be debiting that particular bank account. Similarly, shares also. They'll be opening a separate pool account for placing all securities. That account will be debited. Similarly, whenever the broker is supposed to receive money, money will be credited into his bank account, that is the settlement account, and shares also will be credited into his pool account, securities pool account. That is the process. So completely automated. There is no manual intervention in this. So entities involved in clearing and settlement, clearing corporation, that is NCL. Then you have clearing banks, clearing member, depositories. Derivatives, basically we have two types of settlements, cash settlement and physical settlement. Until some 4 or 5 years back, we had only one type of settlement, that is cash settlement. So this physical settlement has been introduced some 4 or 5 years back. So what do I mean by cash settlement and physical settlement? So cash settlement, again, nothing but simply the money, I mean the amount which you have created as profit will be paid to you. So going back to our example, HDFC Bank. So what I told I'll buy at 1,000 rupees on 29 September, but on 29 September the spot price is 1100. So in cash settlement, what happens? 1100 minus 1,000, 100 rupees is paid back to me on that settlement day. That is cash settlement. Physical settlement, what happens is I will be given 100 shares of HDFC Bank on 29 September. So my demat account will be credited with 100 shares of HDFC Bank. So later on, after me receiving those shares, I need to again sell it back into the market. That is physical settlement. So cash settlement, only the difference will be paid. Physical settlement, you will actually get the physical asset, or you will be actually paying the physical asset. So for what type of contracts this is applicable? All index based products are cash settled, and all individual stock futures and options are compulsorily settled physically. So futures and options on stocks, that is HDFC Bank futures, TCS futures, Infosys futures, they are stock futures or stock options. They are settled physically. So on expiry date, if you are still holding the contract, you will be getting the shares, or you will be supposed to pay the shares. Index Nifty. Since Nifty, you can deliver Nifty shares or Nifty as a security. So that will be cash settled compulsorily based on the Nifty value. So that is about the settlement. Settlement, cash settlement and physical settlement. Now, let us see this particular part, MTM, settlement mechanism of futures contract on index and stocks. Okay, so settlements, MTM settlement and final settlement. MTM settlement happens on a daily basis. Final settlement, as it is mentioned, it will happen on E plus 2. E is nothing but expiry date. Expiry date plus 2 days of the futures contract. Okay, daily settlement is called MTM, and the final one is called. Now there is something called margin account. Since I mentioned earlier in my slides, so when you are taking these derivative contracts, you have to pay something called margin. So, so this particular account, as an investor, whenever you are trading in derivatives, broker will be opening something called a margin account or a ledger account under your name in his books. So you will be transferring money to him, and he will be maintaining this particular account in his books. A ledger account will be maintained in his books. So from this account, the respective margin will be debited or credited. Okay. So as exchange guarantees the settlement of all trades, and to protect the system and itself against default, it charges various margins from the brokers. So obviously, whenever you take a derivative contract, you'll be supposed to pay many margins. It's called like extreme loss margin, initial margin, span margin, etc. So brokers in turn charge margins from their customers, obviously. So brokers, whatever margins which are levied by exchange, they will not bear it. They will collect from the investors. So in futures contract, margin generally includes initial margin and exposure margin. So these two margins are involved. Now coming to MTM. So having understood about margin account, now let us see how this margin account will be debited or credited on a daily basis in the name of MTM. So MTM, nothing but your, whether on any given day, whether on the day you are into profit or losses. Say example, today I bought at 100 and closing is at 1. Today I made a profit of 10 rupees. So the 10 rupees is my MTM profit, and that will be credited into my account. Tomorrow the closing price is say 100. Yesterday 110 is the closing price. Today 100 is the closing price. So a loss of 10 rupees. So that will be debited from my MTM account. That is margin account. So this is called MTM, daily netting of your profit and losses. Daily calculating whether the position which you have taken is in profit or losses, and the respective margin will be collected accordingly. Okay, let us see with an example. Say example, I bought a Nifty futures contract on 2nd August 2020 at 15,000. Okay, when the futures price is at 15,000, I bought one Nifty futures, and the lot size is 50. So here every contract will have something called lot size. So here the lot size is 50. So what do you mean by this? Just a minute. Yeah. So here 15,000 multiplied by 50, that is 7.5 lakhs. So my contract value is 7.5 lakhs. Hope it's clear. So my contract value is 7.5 lakhs. That is one Nifty futures contract is equal to 7.5 lakhs, and that Nifty will have 50 Nifties in it. So 50 into multiplied by the Nifty futures price, that is 15,000. So my contract size is 7.5 lakhs. Okay. So this is again another contract specification which we can understand. Okay. Now going back to the MTM part. So my opening will be 15,000. I bought at 15,000. On 2nd August, the closing price is 15,050. So straight away, my profit is 50 rupees for that particular day. Okay. Now here, coming to the margin account, as I told, we'll be opening something called a margin account with the broker. So understand. So let us understand that this is particular ledger account or margin account with the broker in the broker books. So here I'll be paying him on 1st August 1 lakh rupees. On 2nd August, I'll be on 2nd August, since I'm taking this particular contract, say example, a margin of 25,000 is charged. So that amount will be straight away debited from my ledger balance. Okay, on 2nd August. On 2nd August, my MTM, that is a profit of 50. So that will be given as a credit. Okay, I hope it is clear till now. Going to next date. Next date, opening price is 15,050, closing price is 15,100. I made a profit of 50. So again, my MTM will be credit of positive or profit of 2,500, which will be given a entry in my ledger. This is again, these are notional entries. You will not be paid 2,500 until unless you finally completely close the account. On 2nd August 2020, you are still holding that position. You have not closed it. So that's why a notional credit of 2,500 will be given. Similarly, on 3rd August also, you have not closed the account. You are still holding the position. That's why a notional credit of 2,500 will be given. Going further, 4th August, it's a loss, 25 rupees, 25 multiplied by 50, 1,250 will be my loss. 5th August, a profit of 250 minus 75. So daily this MTM will be calculated. Say example, on 8th August, you have decided to close the contract. Okay. So what will you do? You will simply inform him. He will close the position in the system. That is, he'll be placing sell order in the system, and your Nifty futures position will be closed. On 8th August also, your MTM will be calculated. That is, here in this case, 300 is your profit multiplied by 50, 15,000, and the initial 25,000 which has been debited or blocked earlier, that also will be released. So overall, you have balance of 1,20,000 in your account at the end of 8th August 20. So that's a profit of 20,000 rupees. So this is about MTM. I'll just pause here. If you have any questions, please.
This is only notional profit, isn't it?
Correct, ma'am. Correct. This is only a notional profit. A notional credit will be given. Until unless you do not close it, you will not be able to encash it.
Okay. So what happens at the day exercise or the day of the contract?
That's what. See, on 8th August, this okay. So on 8th August, say around 3 o'clock, he has closed it. On at 3 o'clock, the price was 15,400. So
right.
on that day, he has made a profit of 300. That credit will be given, plus the margin which has been blocked, that will be released.
Sir, what would have been in the case of options then?
I'll tell you, sir.
Yes, sir.
We'll go to that. We'll go to that. Ma'am, hope it is clear.
So when you say, this balance of 1,20,000 means it's not realized profit, or it will come.
No. Here, when I am releasing the margin, means I am closing the position. So once I do this, this money is completely available to withdraw.
So that's at the realization point, isn't it?
Correct.
Thank you.
Yeah. Okay, going further. So we have seen MTM. Now coming to the something called final settlement for index derivatives. That is, final settlement will come to nothing but on the date of expiry. On expiration of futures and options contract, all open positions are marked to market to the final settlement price, and the resulting profit or loss is settled in cash. Final settlement, profit or loss, obviously will be debited or credited to the respective bank account. That is, exchange will debit the trading member or stockbroker bank account. Stockbroker will be again in turn debiting the investor's bank account on T+1 basis. Okay. Stock derivatives for futures on expiry, all MTM will be calculated and resulting profit or loss is settled in cash, and all open positions will be closed for physical settlement. So if you see in index, it is compulsory cash settlement on the final, and for stock derivatives, it will be compulsory physical settlement. That is, physical shares will be debited or credited. Okay, now having talked about settlement, and we have seen that settlement will happen on a daily basis or final settlement price. But what exactly is the settlement price? So what is that closing price on which the settlement, at which the settlement will happen? So we'll try to understand that. So daily settlement, that is for mark to market, daily settlement price is the closing price of the respective contract on such day. So what I'm trying to say is, you have two markets, spot market, futures market. The price of the asset will be different in spot market and futures market at the beginning of the contract. Say example, if you buy Nifty index futures, so the Nifty index futures price today will be different from the Nifty index, actual Nifty index level today. Say if the Nifty index level is say at 1000, the Nifty index futures price can be 1010 rupee or it can be 990 rupees also. Both the prices will not be same at the beginning of the contract. Okay. So what I'm trying to say is, there are two different markets called spot market and derivative market. The underlying asset price is different in spot market and different in the derivative market. So here for the daily settlement price, the closing price or the settlement price is the price at the end of the day in the derivative market. So for your MTM calculation on a daily basis, the closing price or the settlement price is the last half an hour weighted average of the asset in the derivative segment of exchange. Okay. So the MTM the MTM will be calculated on the last half an hour weighted average price of the contract in the derivative segment of the exchange, that is the F&O segment of the exchange. Now coming to final settlement, that is on the expiry day. On expiry day, the final settlement price is the closing price of the relevant security in the spot market, in the capital market segment of the exchange. Okay. So MTM will happen on the closing price of the derivative market price. Final settlement price or final settlement will happen on the closing price of the spot market price. So the closing price of the underlying asset again is nothing but the last half an hour weighted average in the capital market segment. So we'll just try to understand with this particular example. Say for a futures contract, this is the futures price, this is the spot price. So on the beginning of the contract, there will be definitely a difference. Okay, the futures price might be more, spot price might be less, or it can be vice versa also. So daily MTM settlement will happen at this price. As the time progresses, the daily settlement price will happen at this futures market closing price. Okay, but on the expiry, definitely these two prices will merge. The spot and futures price, and the final settlement will happen on the closing price of the spot market price. Hope it is clear. Okay. So on the expiry, both the prices will merge. There will be only one closing price. There is nothing but the closing price of the spot market. and the final settlement will happen at that particular price only. Settlement mechanism of options contract on index and stocks. Now in options, you have two types of settlements, premium settlement and the final settlement, which happens on the E plus expiry plus 2 days after maturity of the option contract. So if the option is expiring on 29th September, that's the expiry date, example. So the final settlement, that is final money movement or the stock movement, will happen on 1st of October. That is T plus 2 basis. Premium settlement will happen on T plus 1 basis, similar to MTM futures. This is but here, unlike
So what is
MTM,
T?
T is nothing but trade day, ma'am. So in futures, you have MTM on a daily basis. Here you will be having something called a premium settlement. Index options are cash settled. Stock options are compulsory, physically delivered. Okay. So premium settlement of option contracts. At the end of each day, the amount payable and receivable as premium are netted, and the net premium payable or receivable will be debited or credited from the bank account respectively. So pay in and payout of premium settlement is done on T plus 1 day. So what I'm trying to say here is, say if I'm buying a call option, I'll be paying premium. So that premium will go to seller on T plus 1. I'll be paying my premium to the broker. Broker will in turn pay to the exchange. Exchange in turn will pay that premium to the seller by T plus 1. Okay. So that is pay in and payout of premium. The premium payable amount and premium receivable amount are directly debited or credited to the clearing member's bank account. So the stockbroker's bank account, as I told, it's completely automated. It will be debited or credited. So what is this netting of premium? Say example, on any given day. So today I purchased a call option, 100 rupees is the premium that will be debited. I sold a put option, 85 is the premium. Since I sold, I'll be seller. I am the receiver of the premium, so that will be given a credit. And purchased another option. Since I bought it, I'll be paying premium, that is 200. So net 215 will be collected from my account. That is called netting of premium. So it's not that we'll be debiting 100, crediting 85, debiting 200. No, one single transaction, that is netting, will be done. This is netting of premium. Now coming to final settlement of options contract. So obviously on the date of expiry, that is again going back to the example, say 29 September. So on 29 September till 3:30, exchange will be waiting to close the contracts. So till 29 September at 3:30, we will just check who all are holding the contracts and whether the contracts they are holding are in the money or not. So that is whether they are generating profits or not. So exchange obviously will execute only those contracts which are in the money, because there is no point executing ATM or OTM contracts. Okay. So all in the money options contract will get automatically exercised on the expiry date. So the holder of ITM call options will receive difference of strike price and final settlement price. So here it's an index option. So that's why I am mentioning difference of prices, because there is nothing like we can deliver Nifty. We will only settle in cash. The difference of price will be settled. The writer of ITM option will need to pay the difference, obviously, since the holder of call option, buyer of call option, within getting profit, he will be getting profit. He will be paying that money. The holder of ITM put option will be receiving the difference of strike and final, and similarly, the seller of the put option will be paying that particular difference. So the buyer of call option, buyer of put option, ITM options, they will be receiving the money, and the seller of ITM call option, seller of ITM put option will be paying the money. That was index. Now this will be stock. Now coming to stock, as I told, for stock options, there is nothing like cash settle, it will be physically settled. So the shares will be delivered. So obviously ATM, OTM will expire worthless and will not be considered for settlement. So the holder of ITM call option is engaged to pay funds and receive shares. The seller of ITM call option will be giving shares and receiving funds. Again, vice versa, the buyer of put option, which is in the money, will be engaged to give shares and receive funds, because give share because right to sell. Put option, right to sell. Call option, right to buy. Right to receive shares, right to buy shares, right to sell shares. He will sell shares and receive funds, and vice versa for put option. Now we have something called do not exercise option. Again, just for your understanding, we'll not just go deep into this, just to give you an idea. Though on the date of expiry, though my option is in the money, though it is giving me positive cash flow, still I have this option called do not exercise. I can give an instruction to the stockbroker, to the exchange, stating that do not exercise my contract. Because technically, even though the option is in the money, but on exercising, some statutory levies, brokerage, taxes, charges, transaction charges, everything will be levied, will be added to it, and overall it can lead to negative cash flow from you. Say example, spot price or say strike price, I agreed to buy at 100 rupees. On spot price is 100 rupees 10 paisa. So here technically I bought a call option at a strike price of 100. On expiry, the spot price is 100 rupees 10 paisa. So technically it is in the money by 10 paisa. Now for that 10 paisa, if I execute, there will be something called additional charges, leverages, brokerages, transactions, everything will be there. On that, if you add up, then ultimately you will be paying more than 10 paisa. So the 10 paisa which you are supposed to get, you will lose that, plus you might be required to pay more than that at times. So just to avoid that, strikes which are very close to the spot market, for those strikes you have this option called do not exercise. So the client can take a call whether he want to really exercise or not. He can calculate, he can do back calculation, and he can give his decision. That is do not exercise. So for in the money, including CTM, the writer is all, again, all this we have discussed in the previous slides, so we just ignore it. And as I told, there is something called taxes which we need to pay. So apart from brokerages, transaction charges, and other expenses, there is STT, which will go to the government exchequer. Is nothing but securities transaction tax. So these are the percentages which are available currently. So 0.05% for sale of an option in securities, and 0.125% for sale of an option when exercised. Okay. For futures, for seller, it is 0.01%. So here it's payable by seller, it's payable by purchaser, payable by seller. These are the STT rates. So coming to the derivative trading at NSE, index futures on Nifty on June 12, 2000, index options on Nifty again, June 4, 2001, options on individual securities, July 2nd, 2001, and single stock futures on November 9, 2001. So close to 2 decades, like derivatives have been introduced to the Indian markets, and I can proudly say this derivatives itself has been introduced to the Indian markets by NSE. So these derivative contracts were not there earlier prior to 2000. We introduced derivative contracts to the Indian markets. And these are just about index futures, index options, stock futures, stock options. We also have derivatives, as mentioned earlier, on commodities, currencies, and interest rate derivatives. So on exchange, currently we have index derivatives only on 3 indices: Nifty 50, Nifty Bank, and Nifty Financial Services. Nifty 50 is the most actively traded index derivative. So we have index derivatives only in 3 types of contracts. That is Nifty index, Nifty bank index, Nifty financial service index. Whereas stock derivatives, close to 160 stocks are there. That is, this is as on 13 July 2021. Because to come into this F&O bracket, for any stock to come into this F&O bracket, there are certain parameters like how actively the stock is being traded, whether what is the weighted average price of that particular stock. There are many other parameters. So only those kind of eligible stocks only will be coming into the stock derivative bracket. On exchange, approximately 1600 shares are listed. 1600 company stocks are listed. But out of 1600, only 160 are available under derivative segment. And this keeps on changing because whenever those parameters are not met, the stock can be removed. And whenever the parameters are being met by a new stock, that will be added into the 160 bracket. I mean that derivative bracket. So this 160 figure will keep on varying. So growth in derivative segment, index options, stock options, index futures, stock futures. So in the last, this is a data about latest 5 years. So volumes have grown phenomenal. So this indicates the increase in the participation from the Indian investing public or investing population. So index options, if you see in 2019-20, that was 10 lakh crore turnover, and 2020-21 alone, it was 26 lakh crore. This is 6.47 because this data is up to July only. Okay, so you can ignore the 21-22 figures. You can just see these 4 years you can consider. Similarly, futures from 67 lakh crore it has gone to 89 lakh crore, 149 lakh crore to 176 lakh crore in the stock futures. So again, this is the percentage of volume, close to 30% in index futures, 59% in stock futures, 9% in index options, and 22% in the stock options. So overall derivative volume, this is the percentage of each and every index future product, stock futures, and index options, stock options.
Sir, currency option, does it come here?
Currency, this will not come under currency, ma'am. The currency will not be coming under this. Currency, as again, it is being treated as a separate segment on the exchange platform. So all the parameters which I told you, like about the settlement part and all those things, will be applicable for currency also. Okay.
Okay, sir. Thank you.
So this again a proud moment for us and all the Indians. NSE is the world's largest derivative exchange in 2020, second consecutive year. In 2019 also, we were the world's largest derivative exchange by number of contracts traded. So this is what I wanted to share with you all about derivatives. Again, from the exchange perspective, the microstructure of derivatives. Now it is open for questions, please, if you have any.
So very good evening, sir.
Yes, sir.
Sir, while we're talking, you have some difference between the future and the spot price.
Sorry, the difference between?
You have some difference between a future and a spot price.
Correct.
So what kind of inference shall we get if suppose the future is larger than the spot or a spot is larger than the future? What kind of inference shall we get? Whether
so
we
here,
any inference?
Yes, definitely, sir. See, when there is a huge gap between spot price and future price, that is not here where the arbitrages will come into place to encash that benefit. So they will buy in one segment, sell in another segment, and they'll make a profit out of it.
Okay, but to our knowledge, we can't trade the index.
Sorry.
We can't trade the index.
Fine.
We're not able.
I'll tell you.
Spot price, we can't able to.
Okay. I'll tell you. See, forget index, sir. Say example, you take HDFC Bank stock. Say HDFC Bank stock, if the spot price is 100 rupees and the futures price is say 120 rupees. So obvious is there. So here, what will the arbitrageurs do? They'll buy spot, sell future. They'll buy the spot, they'll buy in the spot HDFC Bank shares, and they'll sell a futures contract of HDFC Bank. So as and when the price, the spot price goes up, they'll make money, and as and when the futures price falls down, they'll be making money. So this is what the arbitrageurs do.
Sir, I think that will be called hedging, if I'm not wrong.
No, sir, this is arbitrage because they are taking the benefit of two different
Arbitrage
markets.
is getting the benefit of difference between price difference between two places like NSE and BSE.
That is for capital market. That is for capital market segment. In capital market segment, in equity segment, NSE, BSE example, what you said is correct. In futures, here it is two different markets. Or say, for example, you take commodity market. Commodity, the price of the commodity, particular commodity in the real market, in the outside, in the normal market, you might say the price of rubber, and the price of rubber futures price in the exchange platform. So what will he do if there is a huge price? He will take the advantage. He might buy rubbers in the real market, he will keep it with him, and he will take a position in the futures market also. So in derivatives, different markets are nothing but the futures market and the spot market.
But sir, I have one more doubt. In such situation,
yes, sir.
जो चीज हमने short की है, whatever we have sold, so we are supposed to cover it also, na?
Correct. Say example, you sold futures, you bought spot, and the price is increasing. So whatever price which is increasing in the spot market, you will make a profit here, and in the whatever loss you are making in the futures market, that will be covered against the profit which you have made here.
Didn't get you. So please repeat.
Say, example, you bought at 100 rupees in the spot, and you sold the futures at 120.
Yes.
Okay. Now, example, if the futures price, since you sold, you will be making profit only when it falls. Correct? When you sell a futures contract, you will be making money when the price falls. Agree?
In cash, we are having the loss also side by side.
No. We'll go one by one, sir. When you are selling a futures contract, you will be making money when the price falls. Correct?
Yes.
When you buy future, you will make money when the price increases. When you sell future,
that's okay. I'm asking how we will get.
So say suppose here it is 100, here it is 120, and say you have taken a position at 120, and say tomorrow the price has increased in both the markets. The price from here it has gone from 100 to 110, and from here it has gone to 120 to 130. So here you made a loss of 10, here you made a profit of 10. Net, there is no risk for you.
So that's what hedging is all about, na sir?
Correct. I agree, it's a part of hedging also. But in derivatives, it can be termed as arbitrage also, because it's a two different markets.
See, whatever I have studied, please correct me if I'm wrong.
Yes.
Whatever I have studied, that arbitration is all about getting the benefit of price difference between two places.
Correct.
Right?
Absolutely.
Example is our सब्जी वाला वेंडर, ठीक है? जिस तरीके से वो होलसेल मार्केट से अपनी सब्जी लेता है, गांव में बेचता है, right? This is similar to the price difference between two exchanges. Like आपने देखा होगा NSE and BSE में कई बार डिफरेंस होता है 5 पैसा to 10 पैसा.
Yes.
1 paisa is always matter.
Yes.
Right.
Yes.
That's why the NSE has stopped कि आप BSc में लेके NSE में बेचो, NSE में लेके BSc में बेचो. Arbitration is not allowed, not has been entertained anymore. This is what I know as of now.
Yes.
And
Yes.
whatever you are telling, I think this is a part of hedging.
Correct.
हम whatever we have bought, देखिए सर, जब हम एक ही कॉन्ट्रैक्ट का स्पॉट एंड फ्यूचर बाय एंड सेल कर लेते हैं, राइट, दिस इज कॉल्ड परफेक्ट हेजिंग. तो इसमें हेजिंग में कभी बेनिफिट नहीं होता है अनलेस अंटिल वो प्रीमियम कम्स इनटू डिस्काउंट, that only we can have profit. Else in normal situation hedging is only covering for uncertainty, only covering for risk. Correct. But not for the profit.
But here also we have two different markets. One is spot market, the other one is derivative market. So it can be a part of, actually it is a part of arbitrage.
Yes,
right?
yes, exactly. Sir.
So hedging you can conceptually, it's very
one
different.
One small doubt, sir. But if I buy in spot price, I sell in spot price, my contract will be not squared off, right? If I bought in,
you're dealing only in spot market.
मैंने एक्सिस बैंक का मान लो 500 का लोट है, ठीक है, मैंने एक लोट बाई कर लिया फ्यूचर, और मैंने अगर उसको कैश में सेल कर दिया तो क्या वो इक्वल हो जाएगा, मेरा बराबर हो जाएगा सौदा?
नहीं,
no,
because there you won't have Axis Bank shares.
I would be having two different holdings. It's like मेरे पास एक कैश में अपना सेलिंग पड़ा हुआ है, शॉर्ट कर रखा है मैंने, एंड दूसरा मैंने फ्यूचर बाई कर लिया था. This is what I am trying to ask you, sir.
I understand, sir. What you have said is absolutely correct. I totally agree with you. Now, okay, now seeing it from a different perspective, say assume a person really has some, say, Axis Bank shares with him from last 3-4 years. Example, he is holding shares in his demat account. Is going to happen with Axis Bank shares. So to safeguard his position, he will take a position in the futures contract. That is hedging. Agree? Now coming to arbitrage, the person until that time, if he has not holding that stock, just because of the price difference, he is taking positions in two different markets. Now here in this case, spot and futures. So this is called arbitrage, is what I'm trying to say.
Yes, sir. That's why they are also called speculators.
Correct.
So they generally speculate every day and make the price.
Speculators, they participate only in one market, sir. Ideally, speculators,
Yes.
they participate only in one market.
Okay.
They buy and sell future on the same day, or they buy and sell spot on the same day. So the example which I gave you in arbitrage is partly hedging also. I totally agree. But for my understanding, for this derivative segment, since we have two different markets here, it will be only futures market and spot market. That's
okay.
It.
Thank you. Thank you for clearing it.
Yes, sir. Yes.
So,
yes. Any other questions? Yeah.
Suppose we bought a contract in options. Now the future price has been increased. Now whether we have.
Sir, can you be a bit louder, please?
I bought an option. For example, say at 17,000.
Okay.
Now the future contract has been now the spot has been moved to 1,700.
Okay.
Now it is possible for me to get the future at 17,000.
No. You mean to say you bought a options contract at 17,000 and spot came to 1,700?
Yeah. Yes.
Such a fall, you mean to say?
Yes.
Okay. No.
And if that is the case, if I am able to get the future using that option contract.
No, you already have a position in option contract. Say, assume you bought a call option at 17,000 strike, and the spot price has fallen down to 1,700. So obviously you will not get any benefit out of that. When it will be out of the money contract. Now here you want to take a position in futures contract, you mean to say, correct?
Yes.
Yeah, I mean ideally there is a possibility. Like if such a scenario definitely will not come, but citing your example, you have that option to take a position in futures contract, assuming that from 1700 it will go to 1800. Okay.
Yes, sir. Okay.
Yes, sir.
So can I ask you down?
Yes, ma'am, please.
So is it advisable in call options to go for out of the money?
Ma'am, actually, as an employee of the exchange, I am not supposed to give any tips or advices kind of a thing. Though you are not asking me any tip or advice, but we generally don't tell anything about that, ma'am. We as an exchange, we provide the platform and we tell what are all these things mean.
Okay,
So it's
because
up to investor call.
okay, I'm asking this is because in the settlement you had said that in case of in the money, it is the buyer receives the shares and pays the money.
Correct.
So if I'm going for a call option, so it would be better to be in out of the money range.
So if it is out of the money, so you want to buy or sell? I mean, buy the option.
Okay, either way, could you just elaborate?
Say example, you want to buy a call option which is out of the money, correct?
Yes.
So you will be paying premium. Now, against your view, if that out of the money goes to in the money in future, then only you will benefit out of it, correct?
Okay.
But the only thing here is premium will be less until unless it is very near to the current spot price. If the spot price is 100 and the strike price is say at 150, so 150 strike price is nothing but a OTM contract, out of the money contract, because if you execute it today, it will give you a negative cash flow of 50. Now this gap of 50 down the line, if the market moves according to your view, if the gap reduces and if the spot goes to 160, then you will be benefiting.
Benefited, okay. Okay, thank you.
So taking OTM, only advantage which I can see is premium will be less. That's it. Rakesh sir?
Yes, sir. I think.
Yes, sir. I think we are done. Yes, sir. So I would like to thank Mr. Rakesh from CUSAT for giving us this opportunity. And I would also like to thank all the respected participants who have patiently listened or been in this particular presentation. It was a really wonderful presentation, wonderful time I had with you all. Thank you once again for your time and patience.
Yeah, I think Vinayak sir, on our behalf also, please accept our thanks. Thank you for the session. Hope to have continued association with you in the future programs also. I think Vinayak was having a meeting at just before that this one also. So I think you will be stressed. I think you said you had a meeting from 1:50.
Yes, sir. Yes.
Yeah.
No, it's okay. It's absolutely fine, sir. No issues.
So thank you for accommodating our request. Thank you, Vinayak. I'll get back to you. So I think participants also now it has been we were on with sessions from morning. I think 9:45, 10 o'clock. So it is a long day.
Okay.
So tomorrow we'll start. I think the schedule is updated in the link. I think it is already done. Tomorrow morning, I think we'll have a session from Lakshmi Madam again. We'll see you tomorrow morning. I'll send you the links, video recorded links, to the group. Right. Okay. So thank you all of you. Thank you, Vinayak sir, and thank you all participants.
Thank you, sir.
Is it
Yeah.
at 10 o'clock tomorrow?
I think it is at 10 o'clock as per the schedule. Yeah. Okay. Tomorrow, no, madam. Tomorrow it is at 9 a.m. Just please note tomorrow's session is at 9 o'clock because Professor Lakshmi is having another session at 11 o'clock. So she will be taking the session from 9 to 11. So please note, I will remind you in the WhatsApp group once again. Please, tomorrow's session is at 9 to 11. The next session after that, we'll have the session at 11:15 to 1:15. And the afternoon session will be at 2:30. 2:30 to 4:30. That's the plan for tomorrow. Please note the time. We start at 9 o'clock. So thank you all of you. See you tomorrow.